Hi, this is CF Liu from howtofinancemoney.com and askcf.com, my branch out site whereby I answer your personal finance queries with no holds bar. Now, when I launched this site, there are some members that actually asked me this question. Her name is Pris. She asked, "Hi CF, can you explain what is the waiver of premium? In summary, investment link policy is like a package for both death and total disability and medical card instead of purchasing all of them separately, right?" And then she also got confused where her prudential insurance agent consulted her about investment link policy, which he claimed that you could do a top-up premium. Now, to answer this question, we first need to understand how investment link policy works. So I will answer this question: what is the waiver of premium, and what is called as a top-up premium? Now, to start, we must understand how investment link policy works. Now, I've simplified this in a very layman terms. Okay, in just one diagram, this is what I draw. Sorry if the drawing is not too nice, but I think it served its purpose. Now, imagine if you have an investment link policy that you are paying a premium of 1,005 a year annually, which is represented by the blue line. Oh, by the way, the y-axis actually refers to the monetary amount, whereas the x-axis refers to age. So imagine if you bought a policy, investment link policy, at the age of 30, represented by the blue line. So your premium now, you are paying like 1,005 a year. However, because you are only 30 years old, the cost of insurance or the insurance charges, which means that the cost that the insurance company need to fork out to insure you, is actually represented here by the red line. Now, this red line, okay, at the age of 30, it could be your insurance charges is 500, but you are paying 1,005. So the difference in this is what we call as, let's just call it as a delta. Okay, this is the difference, delta. The 1,000 difference would be your cash value, which means that this 1,000 of extra premium on top of this is 500 is what insurance company take, but the 1,000 is assuming it is a cash value that insurance company takes this 1,000 and they put this money into a unit trust fund that is managed by the insurance company themselves. Okay, so this difference is what insurance company is doing for you. They just take your money and invest in a trust fund. And of course, the red line, as you see over here, is increasing. Why? Because as you get older, we know that the cost of insurance, it's actually higher. So as you get older, it increase. But your insurance policy for this investment, then you are still paying 1,005 a year until a point whereby the insurance charges breaks even, or it meets the blue line over here, assuming, let's say, you're at 60 years old, where the cost of insurance would be break even at 1,005, and 61 years old onwards, the cost of insurance will actually increase, okay, more than 1,005. It could be 1,008, 1,009, and it just progressively increase. So the premium that you are paying it's still 1,500. Actually, it is not enough to cover for these insurance charges after 60 years old. So what we'll do is that if we can represent this quadrant, let me highlight that to you, the green. This green quadrant would be the total accumulated cash value from the age you are 30 until 60 years old. So when at the age you are 60 years old until say 75 years old, where the insurance charges is higher than your premium pay. So where does this money, you are not paying more than 1,500. So where does insurance company take this money to cover their costs to insure you? It is by this portion, the green. Okay, the yellow, what is missing or what is lacking in the yellow portion, it will take from what you have accumulated in the green portion. So that is how an investment linked policy works. Now, what if it keeps on increasing until to a level when you are 75 years old, the insurance charges is actually 3,500. Okay, so imagine that at the age of 75, this green portion, okay, the monetary amount that is lacking from what you are paying versus what are the insurance charges that is charged to you at that age. Imagine this portion, it is covered by this portion, and at the age of 75, both your reservoir that you have built up the cash value from the age you are 30 until 60 years old has already been used up when you are at age 75. So what will happen then? When your cash value has been used up, what will happen is, if you still need this policy at the age of 75 and above, you have no choice but instead of paying 1,500, which is represented by the blue line, you now need to pay what is represented by the purple line. This is what you need to pay now, and it keeps on increasing. So it could be 3,500, 3,600, and 3,700 at the age of more than 75, when your reservoir over here has already been empty. So what is the solution to this? Well, there's two solutions. Remember that when we design, okay, anyone design an investment linked policy, you can actually pay 1,500 a year, yes, but you could actually also pay more than that. Okay, what do I mean by that? Let me show you. Okay, what are the shapes? Okay, so let me show you. If you were to pay instead of 1,500, you are actually paying, let's say, 2,000, represented by the orange color line. So you can imagine that, oops, let me draw this again. Okay, so you can imagine that your reservoir would be somewhere here and here, right? Because you are paying more earlier, and then of course your reservoir will be much larger, and it actually can, what we call as a policy sustainability. When your reservoir is large like this, because you pay more at the start, you commit to a higher premium at the start, your policy sustainability will be much longer. If you can extrapolate this, and you can imagine that it could probably last until 90 or 90 something years old before this green portion or your reservoir cash value runs out. Okay, and this is not the only solution. Now, remember that if you were to pay this much, you can actually build up your reservoir a lot. However, not a lot of people have that much of money to pay too much premium to an insurance policy a year, and we actually don't recommend it to pay too much insurance, because insurance is not the only thing in life. So what you do is that to prevent this and this reservoir from being empty at the age of 75, what you can do is actually between the age of 30 to 60, you progressively add in a lump sum of money, as 1,000 or 2,000 every year, to build up your cash value before you reach 60 years old, to put it very simply. And because if you dump in a lump sum amount like this, it is called what we call as a top-up premium. It is not a premium that you need to commit. It's not a premium really that you need to commit to an insurance policy, so that kind of lightens the burden of committing too high of a premium for insurance policy, just because you want it to sustain longer until before you die. So this is how an investment-linked policy actually works. To summarize, there's two solutions to this to prevent your reservoir from being empty. The first one is that you commit to a higher premium upstart, but this would be more straining to your budget or pocket. And the second thing is you progressively every year dump in a lump sum amount, a few thousand, 1,000 or 2,000, and let it compound and let it build up your cash values over the years, so that when the time after you are 60 years old, this policy will still able to sustain using a larger pool of reservoir which you have built up for the past 30 years old, when you are like 30 to 60 years old. So I hope this explains how investment-linked policy works in a very simplified manner. Now, to actually demonstrate how you can visualize the real numbers, now I'm going to actually show you a real sales illustration for insurance policy. Now, because these are the exactly sensitive thing that is not meant to be shown in public, but it helps to actually explain things, the concept that I have actually explained over here. So the next part of this video will be only available in only askcf.com, where there would be an exclusive demonstration and really show you everything, no holds bar, on what I mean by this, by showing you the exact policy and the quotation of various insurance company. So stay tuned for that.